Okay, hi everyone. Welcome to today's webinar. For today's session, we are going to be talking about the ICT trading strategy, and this is the first part of our two-part series for this strategy. So if you guys have any questions, feel free to pop them into the chat. And yeah, let's just go ahead and get started. Okay. Before we get started, as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, I'm Melanie and I'll be a speaker for today. I'm an investment analyst from Rocket, who are finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We are going to look at a brief intro to what exactly ICT is, and then we'll look at the key concepts that ICT uses, and then we'll look at understanding what exactly the trading strategy is, and lastly, we'll look at what smart money looks like in price action. Okay, let's go ahead and get started. So what exactly is ICT? So ICT is inner circle trading, and it's a trading method that focuses on understanding the inner workings of the financial markets. So it focuses solely on price action and was originally created by Michael Huddleston to trade the Forex market, but traders are using the same strategies to profit in other markets as well. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So why is it important for us to understand ICT? Well, in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give us a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage risk. So you can do this since ICT methodology employs chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so some key concepts. Firstly, it involves liquidity and displacement, market structure shift, inducement, fair value gap, optimal trade entry, and balanced price range or order blocks. And we'll get into each one of these in our next couple of slides. Okay, so firstly is liquidity. There are two types of liquidity, basically the buy side and the sell side. So buy side liquidity represents a level on the chart where short sellers will have their stops positioned, whereas sell side liquidity is just the opposite. Let me see. Yep, so we have this chart here. So smart money players will understand the nature of this concept and commonly will accumulate or distribute positions near the levels where many stops reside. So earlier I mentioned buy side over here, sell side over here. So if you're familiar with our other webinars where we talked about support and resistance, we have a question. Do you provide certificates? No, we don't. Yeah. Okay. What was I talking about? Yeah. So swing highs and swing lows basically involve this very similar concept to that. And we'll get into this a little bit later on. We have some examples of multiple swing high resistances and swing lows supports. And those are really good levels to use for your buy side liquidity and sell side liquidity as well. Okay, so I guess the main point of liquidity for the first part is just that the sheer amount of stops at these key levels will allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, which is why we want to trade these levels with multiple swing highs or swing lows and seeking liquidity at the opposite extreme. Okay, just give me a second. I'll be right back. Okay, sorry about that. So next, we're going to look at displacement. So displacement is a very powerful move in price action, resulting in strong selling or buying pressure. So generally speaking, displacement will appear as a single group or a group of candles that are all positioned in the same direction. Yep, so this session is being recorded. So I think if you email IronFX, they might send you the recording. Or it might be on YouTube as well. I'm not too sure. But this session is being recorded. I think you can email IronFX on their website, and they'll be able to help you out. So these candles typically have large real bodies and very short wicks, as you can see here. So you can see the strong selling pressure would obviously be in a bearish momentum, moving in a downward trend. You can see the big bodies of candlesticks followed by small wicks. So this is strong selling pressure, and they're all moving in the same direction. So this kind of candlestick shape basically suggests very little disagreement between the buyers and the sellers. So obviously, if there is a strong buying pressure, you will expect the opposite. This is also pretty similar to candlestick shapes if you are more familiar with that trading strategy. Uh, but yeah, it's basically the same concept. Okay, no worries. Yep, so often a displacement will occur just after a liquidity level has been breached. So previously we talked about the liquidity level like this. So you can see that um that displacement happening immediately after over here with the big bodies and small candlestick wicks. Okay, so it normally happens just after liquidity level has been reversed or breached and will often result in the creation of a fair value gap and a market structure shift. Okay, so next let's talk about market structure shift. So market structure shift is basically the general trend. So there are two types of trends. Obviously, if there is an uptrend, price is making higher highs and higher lows. And if there is a downtrend, price is making lower highs and lower lows. So here's an example of a market structure shift. You can see the swing highs and swing lows. We say that it needs to be significant because this is the kind of market structure that we're looking for whenever we go in with an analysis. So even if we're not talking about ICT, if we're talking about Fibonacci, or other kinds of trading techniques, we want to look for market structures that have this very clear shape of swing highs and swing lows. Okay, so you can see here the kind of market structure. It's a very clear downward trend here as well. Of course, in this example, we are using a descending trend line as well to identify the trend in this market structure. Okay, next, let's look at inducement and fair value gap. So we'll start off by looking at the inducement. So rarely does the price move in a straight line. So within a larger trend, there are always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So here's an example of what we mean by inducement. So the price here, where we identify the inducement, the price will bounce or get rejected, and then we'll target a previous short-term high or low before continuing in the same direction as the longer-term trend. So in this example, you can see the market structure shift occurs when price breaks below this swing low here, this swing low support. So it's now moving in a downtrend. That's the first point. Secondly, to identify the inducement, price is kind of moving upwards slightly, very slightly, before reversing back down and breaking out of that that swing high, that very small swing high resistance here. Okay, so it breaks down again, and then the same kind of pattern occurs throughout. So this is what we mean by inducement. Okay, so that's what we mean by short-term highs or lows, and these are the areas where you can place your stop losses if you're going in for a very small buy towards a take profit. Okay, now let's talk about the next point, the next key concept, which is fair value gaps. So fair value gaps are created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. So these imbalances are visualized on the chart by a 3-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. Okay, let's look at what an example of that looks like. Okay, so here are the fair value gaps that have been filled and unfilled. Okay, so these imbalances, as we mentioned earlier, are basically a 3-candle sequence, right? So if we look here, you can see the 3 candles here. Okay, if we just look at the fair value gaps that have been filled. Okay, so these 3 points, 3-candle sequence containing one large middle candle, as you can see here. And you can see the bordering candles, upper and lower wicks, don't overlap between that. So that's why we are highlighting the gaps as well. So you can see the blue lines or the blue areas are where we are highlighting the levels that are not overlapped. Okay, here as well, the unfilled fair value gaps. Okay, I know this part can get a bit confusing, so let me know if you guys have any questions about this. Okay, if all good, we can move on. Okay, let's move on. So our next key concepts that we're going to be looking at are the optimal trade entry as well as the balanced price range. So optimal trade entry represents the best places to get into a trade, identified by using the Fibonacci between 61.8 and 78.6. Balanced price range or imbalance is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. Okay, so what's left after either of these instances is um essentially a double fair value gap, which can act as a magnet to the price before a continuation move higher or lower. Balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, now let's move on. We're gonna do a brief intro to Fibonacci in case anybody was unfamiliar, since the ICT method uses Fibonacci as well. Okay, so a couple of steps that we can look at. Firstly, is the market structure clear? We want to look for any big zigzags that we talked about earlier. Okay, and then we want to identify the recent trend. So our prices going down or up. Next is to identify recent major swing lows or swing highs. And then connect the 2 points. Basically, the highest to lowest in a downtrend and the lowest to highest in an uptrend. Okay, so this is an example. So you can see all the different Fib numbers um, that we highlight in this slide. So we use three different kinds, well, actually four different kinds of Fibonacci techniques. But in this image, it only shows the three types that use your Fibonacci retracement tool. So it's all the same tool, but with three different methods. Okay, so the mid-range we call our Fibonacci retracements. So that's the 0 to 100% range. And then for negative levels, so your minus 27.2 and the minus 61.8, we call that the expansion levels. Okay, and lastly, the levels that are greater than 100%, those are our extension levels. Okay, namely, for extension, we namely use 127 and 161.8. Okay, but for all of these different Fibonacci techniques, we are using only the same tool, which is your Fibonacci retracement tool. Okay, so here's what it looks like. You can see price bouncing off the highlighted area, the 61.8. So here's an example of how you can use that. And earlier on, we mentioned that the ICT method of entering a trade is typically between 61 and 78.6 level. Okay, so what does smart money look like in action, in price action? So smart money basically involves looking at support and resistance, reversals, and volume. And there are a couple of key components. So firstly, we put your order block. These are basically a replacement for the supply or demand that your asset experiences. Okay, and then breaker blocks or mitigation blocks, these are basically your support and resistance levels, just with a different name. Fifth, you also have your flip zones, which are the levels where you have reversals. FVG is the fair value gaps that we talked about earlier, basically imbalances in the market when demand, for example, it's when demand outpaces supply or vice versa. And lastly, liquidity gaps, which again, we talked about earlier as well, where there's a lot of swing highs or a lot of swing lows that are testing that same area. Okay, so liquidity pool manipulation. This basically refers to areas on a price chart where significant clusters of buy or sell orders are located. These liquidity pools act as magnets for price as they represent zones of substantial market interest. So by identifying liquidity pools and understanding their significance, traders can anticipate potential price movements and position themselves accordingly. Again, this is what we talked about, where you have large areas of swing highs and swing lows that test that area. Those are basically your liquidity pools. Okay, so trade management. Let's talk a bit about trade management because this applies to pretty much any trading strategy that you use. Okay, so firstly, why is it important? Of course, firstly is to control risk. So it helps you to limit your potential losses and manage your overall risk exposure. Next is to maximize profits. So trade management strategies such as your take profit orders and trading stop losses will help you to trade and lock in profits and maximize your returns. Next is to manage your emotions. So anyone who has traded will know that especially in volatile markets, you can get quite irrational or you can be, I guess you can prevent impulsive decisions that are driven by fear or greed. So it helps you to stay calm and rational. Number four, improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed trading decisions and avoid the cost and time of having to constantly monitor your trades and adjust your positions. And lastly, increase consistency. Um, so since you're reducing the impact of individual losses, you can then maximize the impact of your winning trades as well. So let's talk about the problem with a fixed take profit and a stop loss. Okay, and why it's important to have um a trailing stop loss, which we'll get into in a bit, and other methods that you can use instead of this. So let's take a look at this example. The red area shows a strong resistance area since there have been two swing highs that are in line. Okay, so if our trading strategy requires us to have a fixed take profit of let's say 100 pips, right? We would place the target beyond the strong resistance area, right? So let's see how this plays out. So you can see price shot up, it missed our profit target by a few pips before reversing back down. Okay, and the key point here is that price tends to reverse off of big areas of resistance and support. Or if we're talking about the ICT method, you can also refer to these areas as your liquidity grabs. Okay. So in an alternative scenario, if we had placed our take profit before the key resistance level, we would have got a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss levels accordingly. Okay, so lesson here again is that don't blindly follow a fixed take profit target just because some forum tells you to. Always look at the charts and adjust accordingly. So the proper stop loss and take profit placement to ensure that you maximize your wins and minimize your losses looks something like this. This is obviously just a recommendation. It's completely up to you what you choose to do. But we normally will recommend you to place your stop loss beyond the resistance area and your take profit should be placed before. Okay, so of course this example involves a sell entry since our take profit is below, right? But in this example, you can see if we're going in for a buy entry, how your take profit and stop loss should be placed, going by that same concept of your stop loss placed beyond and your take profit placed before. And I guess the understanding behind it is that your stop loss should be placed beyond a key Fibonacci confluence area. Here we're talking about Fibonacci confluence, but this can apply to pretty much any resistance area or any big support area. So it could be like your big areas of liquidity or swing highs and swing lows, so on and so forth. This applies for that as well. Reason being, price is attracted to such areas of confluence. And if your stop loss is right before it instead of beyond it, you will most likely get stopped out before the market reverses. So that's one of the reasons why most people wonder why they got stopped out right when the market starts to reverse, and then they start complaining about stop hunting. Okay, and next, your take profit should be placed before a key Fibonacci confluence area because when price reaches that area, so again, it doesn't have to be Fibonacci, it could be swing lows or swing highs again. And once it reaches the confluence area, there's a high chance that it won't be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. Okay, so that's one of the reasons why people complain that the market is being manipulated, maybe because they missed their take profit by 1 or 2 pips. Okay, so here's an example to show you why you shouldn't have a fixed stop loss. So we have a support level with 2 swing lows in line with one another. Price has bounced off this support level and we are expecting it to continue to rise to the swing high resistance. Our stop loss of 100 pips is fixed at the 1894.75 level. Okay, it's a support level. So price goes down, instead touches the stop loss and bounces perfectly from the support. Okay, so what we should have done instead is to place our stop loss slightly beyond the key level so that we aren't stopped out at the support, as price tends to be attracted to these key levels as we mentioned and bounces off of them. Okay, so instead of having a fixed stop loss, what you can do is use a dynamic stop loss. So this applies for any trading strategy that you choose to use. Okay, so dynamic stop loss basically is it's a stop loss level used in trading where you adjust your level based on the market conditions, basically. So the level of the stop loss is continually moved to a more favorable position as the price of your asset moves in the desired direction. So the goal of dynamic stop loss is to lock in profits while minimizing potential losses. Placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trends. So as we mentioned earlier, this ties in really closely with what we talked about previously, where our inducement. Okay, so you can place your stops over here after that price has, shot up slightly. You can catch that slight movement. Okay, let's look at partial profit as well. Okay, so here's our first example of a partial profit, since we've been talking about having a dynamic stop loss, dynamic take profit. Another horizontal level that you could use is a partial profit, where basically if you're not sure if price is able to push past that area, you get out, or rather you kind of collect a couple of wins over here, just in case price doesn't reach your take profit. So in this example, we can see price reacting off that strong resistance area at our partial profit, and it reversed off of it, heading towards our take profit. Okay. Idea and validation. This is quite close to what we talked about the partial profit. So idea and validation is usually placed before your stop loss, and it's the level at which you basically admit that you're wrong and you want to get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So firstly, entry. Your sell entry is at number 1, and we're hoping for price to drop all the way down to our take profit target here. Idea and validation occurs at this swing high here, and it's the level where we admit that we're wrong and we want to move our take profit over here to our entry. Okay, so you can see we managed to get out of the trade and break even before price rose further and would have gotten us stopped out. So here's an example. Here you can see our entry take profit. The take profit is in line with a 50% retracement. Okay, the entry is just at the swing low. Okay, so we're expecting price to bounce off of this level and head towards our take profit. But we have identified this 127.2 as well as the minus 27.2 lines up nicely. So this is a confluence area. Okay, so what we do is we then place our stop loss below these levels and our take profit over here in line with 50% retracements. Okay. Our idea and validation, we place it slightly above your stop loss. So if price triggers your idea and validation, we'll then move our take profit to our entry level. So you can see it was triggered. So we move our take profit to our entry over here. So we get out at break even. Okay. Okay, so if we didn't have that idea and validation and um moved our take profit to the entry, we would have gotten stopped out over here. Okay, another method um for stop loss is your trailing stop loss. So all of these trade management techniques can be used for your ICT as well. Okay, I'm just gonna really quickly go through this. So trading stop loss is basically a type of stop loss order that's set at a certain percentage or dollar amount away from the market price. The idea behind a trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss move follows the market price as it moves in favor of the trade. Okay, so the trading stop loss technique is useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. So of course, this is very different from your fixed stop loss that we talked about earlier, which is set at a specific price and doesn't change as the market moves. So this is particularly useful for trending markets, and I'll show you guys in the next couple of slides why I say so. So there are a couple of different methods for your trading stop loss. First is your moving average indicator, followed by parabolic star, chandelier and ATR, support and resistance levels, and a combination of all of these methods. So firstly, we have your moving average. Okay, we have price breaking out of this ascending trend line, and price is breaking below your moving average as well, which is a bearish signal. Okay, so you can see price start to move in this descent downward trend. With price moving below your moving average, once it moves above it, your trading stop loss is triggered and you get out the trade. Okay, so it got us out before this happened. Again, it's the same price chart, but on a different, using a different method. So now we're using a trend line breakout. Price is moving in a descending trend line. So remember, for a valid trend line, it needs to have at least 3 touches. So here we have 1, 2, and 3. So you can see price moving in a descending trend line. Once it breaks above the trend line, we are stopped out. Same chart again, using parabolic SAR, price moves below your parabolic SAR and breaks out of this level. And once it moves above, your stop loss is triggered. I think you can kind of get the hang of it now. But we're just using that same method on different indicators. So this is another way that you can, I guess, kind of build that confluence. After you've done your technical analysis, done all of that, you can go in to confirm your analysis using your indicators just as a trade management technique. So you can go in with moving averages, chandelier and ATR on your chart, and if they all give you that same I guess that same signal. So if you see all of them moving below your indicators, then that's a bearish signal, right? So if they all give you that same signal, then it's suggests that your analysis is correct. So price is moving below it, triggers both the ATR and chandelier and gets stopped out. So here's a real life example. Okay, we're using the moving average now. So price is moving below. Once it breaks out here, we go in for a sell entry here. Okay, so going for a sell towards our take profit. Once it breaks above, then we get out of the trade. Okay, another example. Price breaks above it. Okay, so using breakouts as trading stop loss. So breakouts are usually really high volatility events, and price can spike up and reverse almost as quickly. So stop loss can help you to manage risk, protecting your capital, and a trading stop can help you to protect your profit, as we've seen so far. Okay, any questions so far? Okay, the next few slides are just a couple of examples on how you can combine all of these techniques. So here we have support and resistance in combination with moving average and your parabolic saw. So with price breaking above both of the indicators, you're obviously expecting price to move in an uptrend. So we're going for a buy towards this level here. And we got that trade. And here at the swing low, that's where we'll place our support level as well, in line with your moving average or where your moving average starts to reverse. Okay. Okay. Next, another example of how we are combining all of the indicators. So when price, here you can see a very obvious swing high. So that's our first resistance. Once price starts to move below both of the indicators, you're obviously expecting a downtrend. Price continues moving downwards, and we get into you can expect your take profit to be at this level here at the swing low. When price starts to move above it, then you can go in for a buy, expect price to move in an uptrend. Okay, so that's what I meant earlier by combining all of the different techniques to gain more confluence. Okay, are there any questions? Okay, we have a question. What's the parameter for the MA? So it really depends on your own trading strategy. If you're a short-term trader, so like if you're a day trader, we would use the 5 or 9 period EMA, the exponential moving average, or the 15 period or 20 period SMA or EMA. Then if you're swing trading, maybe 50 to 100 period for both SMA and EMA. Yeah. Obviously, there are also a couple of popular combinations for moving average. You can use your cross, your golden cross, death cross, in which case your 50 period and 200 period SMA will be your will be used for that method. Okay. So yeah, it depends on your trading strategy and which time frame you're more comfortable using as well. Okay, I think that's just the same. I think that's it for today's session. Let me know if you guys have any other questions. If not, feel free to leave the session. Thank you guys so much for joining me today. I hope you guys found this session helpful, and I will see you guys again next week on Wednesday. I was just ill this week, so I wasn't able to make it on our usual time on Wednesday. But thank you guys so much for joining me today on this Friday afternoon. But next week we'll be back to Wednesday afternoons. Thanks, everyone. Bye. Okay, do you recommend Fibonacci numbers as parameters for moving average? We normally will use Fibonacci levels to find confluence areas more than to use it for moving average. We normally use indicators like your moving average and parabolic star, so on and so forth, and Ichimoku just to confirm your analysis. So Fibonacci and your other technical analysis tools will use that, like your support and resistance, will use that separately. Um, and then moving average, Ichimoku, all of that will come more of as a confirmation of your analysis. Or that's just how normally we like to use it. Um, yeah, so I'm not too sure because I've never really tried that, but you can try it and let me know how it goes. Yep, no worries. Yep, if you guys like me, feel free to add me on LinkedIn as well. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye. Have a great weekend.